Hello everyone, and welcome to your Glassnode video report for week 45. I'm your host Checkmate, and we're recording this on the 9th of November 2021. So we're sitting just below all-time high at the moment, and in fact, at the time of recording, we're about 66,200, so really attacking that all-time high. And whilst price is consolidating up in this range, what we're really looking for is what is the investor conviction and overall sentiment, spending behavior. What does that look like on chain? Does it support the all-time high behavior? And what we've incredibly found this week is that really a lot of the sentiment remains very, very constructive. So most of the investor conviction that we can see on chain looks very, very strong. We're seeing strategic spending that we've seen over the last couple of weeks. And what we're really going to look at is this supply side assessment of the spending pressure and what that's telling us about the market, the demand side assessment, including on-chain activity, which is actually quite a fascinating divergence that we'll discuss. We look at things like the exchange balances and coin flow dominance. So are we seeing more coins flowing in or out of the exchanges? And then we'll do an analysis on the mining market, which has really almost recovered back to the highs, and just really assess some of the mining revenues just to understand that balance between miner BTC denominated revenue and fiat denominated revenue. So let's jump into the dashboard and get started. So as we mentioned in the intro, it's been an extremely strong week for both Bitcoin and Ethereum reaching all-time highs, Bitcoin hovering just barely below its all-time high. And what we've really seen is a very, very strong consolidation. We've talked about this bull flag over the last couple of weeks, where really October was an incredible month for overall gains. $23,000 was the overall candle when you include the wicks. And really the market has held on to and continued to push higher, held on to all of those gains and continued to rally. So overall, very, very strong in terms of price action. So now what we're going to look at is, does the supply side dynamics really support that? So in all of these markets, price meets in the middle between supply and demand. And by and large, the majority of supply is held by existing coin holders. And as you know, we generally try to classify these cohorts of coin holders by, are they experienced long-term investors, or are they relatively new and they haven't quite seen the volatility? They may be quite new to the market. So we generally use lifespan as this categorizing factor as to how we understand these different cohorts of investors. So this is our long and short-term holder supply, profit and loss. So to break down this metric, we have our long-term holders in blue. This is looking at the percent of the supply. So between 40% at the bottom here and 100% of the total circulating, how much of it is owned by long-term investors, and the red is then short-term holders. Now, the dark colors are those that are in profit, and the light colors are coins that are held at a loss. So we can kind of classify these different cohorts depending on how long they've held their coins for and what their behavior patterns look like, and then also by their profit and loss. Now, what we saw is that we hit this point, which I call peak HODL, which is this zone where we have the maximum number of coins held by long-term holders, and you can actually visualize what we call a supply squeeze, where as the market rallies up towards the all-time high, short-term holders come into profit, long-term holders come up into profit, and we get this squeezing where the long-term holders hold a huge portion, this is about 80% of the supply, then they commence their distribution. So as the market rallies into a bull, long-term holders distribute, we start to form a topping pattern, and this is where long-term holders start reaccumulating. So during the depths of the bear market that we saw back here in May, we saw long-term holders start adding to their positions. Now, we've reached something that looks quite similar to a peak HODL. This is about 81% of the supply, so it's actually higher than what we had back here in 2020. So long-term holders have added a huge portion of supply to their reserves, and we've only just started to see a very, very small amount, about 0.79%. Of the total supply has been distributed. But what we're not seeing is this being a massive exit. We're not seeing long-term holders going, okay, that's it, 66,000 is the top. What we're seeing is some spending, but it looks a lot more like strategic profit taking rather than, okay, the coin's expensive and the top is in. So maybe we'll see that in the future, but right now we don't quite have that pattern. So to really put some light on that, this is our long-term holder net position change metric. It looks at over the last 30 days. What is the overall accumulation or spending rate? Now, as we mentioned, this large red zone, this is distribution, and it aligns with where we're seeing long-term holder supply declining quite significantly. So if you take this node here, 30 days ago, obviously there was a lot more supply, so therefore they have distributed. What we've then seen is a massive growth in accumulation. This was about 5 months where we can see this very, very strong growth in long-term holder supply. Now, note how this is pulled back to roughly a neutral level. It's pulled back to roughly zero, right? Give or take a little bit. What that's really saying is that over the last 30 days, long-term holder supply is flat. So what was accumulated was then spent. So it's kind of showing we're not exactly in this huge distribution phase yet. We've just returned to neutral. So over the last 30 days, the balance is overall flat. So to kind of put a little bit more color to this in terms of the spending patterns, we've got our spent volume age bands. Now, what this is really looking at, we're going to look at the more detailed chart in a moment, is a breakdown of the coins based on their age and how much of the total coin volume they fill in terms of the transaction volume, how much of it was a year old, how much of it was 6 months old. We'll come back to that momentarily. Before we do, let's look at our revived supply. Now, what we're looking at here are coins that are older than 1 year. So when you've held Bitcoin for a year, you've seen some volatility, you've seen regulations, you've seen all sorts of chaos. Generally, people who've held their coins for a year are relatively seasoned. They're more likely to understand the asset, the general flow of the market. So what we're looking at here is the total coin volume, right? We can see 20,000, 5,000, 10,000 coins coming back to life that are older than a year on a daily basis. So note that our pre-bull phase back here in 2019, 2020, we're talking about somewhere between 5,000, 7,000, that kind of realm of total coins older than a year coming back to life. Here's that distribution. Note how this red pattern in our long-term holder supply matches very closely to the distribution. So these are old coins taking profits on the way up. Very, very normal in bull market behavior. We then see it really start to calm down during the May through to June, July period. We can see it actually pull back to get even lower or down to the lowest points of this pre-bull phase. And really note how it's kind of quite similar. It's really trending in a very, very similar behavior to what we saw back here in 2020. It looks like the amount of coins coming back to life is actually quite similar to a bear market. Now that's very interesting because remember, a bear market authors the bull market. Bear markets come before bulls. We definitely saw a lot of behavior on chain that looks like a bear market through this period. And really the definition by my book of a bear is when you have all of the tourists and people who've come in just for the speculation, they leave the building, they get flushed out of the system, and generally it's only the smart money who remain. They step in and start accumulating. And you'll see that in a number of these metrics, this is actually quite similar to what we have at play right now. So I mentioned the spent volume age bands. We're looking at this here on a 14-day moving average just to smooth out some of the daily noise. I filtered for only coins older than 3 months. So it's only those older coin brackets. And note that our axis here, we're talking about 2 to 4 to 6%. So only, let's say 6% of the total coin volume of all the BTC moving around the network, less than 6% at the current moment is actually older than 3 months, which is telling you that the other side of that equation is 94% of the volume is fairly young coins, younger than 3 months old. But note how we had this very sustained pickup in older coins being spent. This is very typical bull market behavior. You see older coins coming back to life. There's a lot more demand, so those coins can be soaked up until eventually we start to form a topping pattern. Now note how we've seen this spike up, right? As we've been consolidating up here, these coins have come back to life. But remember that we have to look at this in the context of the broader market cycle. Price traded sideways and is actually pushing up to all-time highs even with this spending going on. So what we're looking at here is, yes, some of these coins are coming back to life. Yes, at the moment it looks somewhat like an event rather than a sustained trend. Bull markets can sustain this sell pressure for some time before they start to top out. But the market is really showing that there is enough demand here to essentially trade sideways and then push higher, even though this spending is going on. So that's a bit of a takeaway message from what we're seeing here in the balance between supply and demand. Now, on a very similar note, what we're looking at here is the HODL Waves. Now, that previous chart was looking at the spending behavior. We're looking at who is spending their coins at the moment, and we can see that, yes, there's been an uplift to some of these older coins. Now, when an old coin is spent, it's immediately repriced or revalued. Its lifespan is destroyed, and we start accumulating from zero. So it's essentially like destroying all the accumulated days that it's been dormant, and it starts back at zero as a young coin and recommences the journey. So you would think with all of these old coins being spent, then surely the young coin supply would be boosted higher. Now, that is true, but note how little it is, right? We're talking, this is the 24 hours, 1 day, 1 week, 1 week, 1 month. We're talking about relatively young coins here, and yes, we can absolutely see this uptick. However, when we look at all of the coins up to the age of 3 months old, right? So these are relatively recent. They've moved within recent market history. We're not talking about coins from $200 or $5,000. We're talking about coins that move within the last couple of months. Look how low our total young coin supply is. This is actually pretty much at all-time lows, and it's sustaining that level. So what we're basically seeing here is, yes, there's some spending going on, but as we saw with the long-term holder chart, it's such an insignificant or small amount, 0.79% of the supply, that it hasn't even affected our HODL waves and brought it up above all-time lows, essentially. So if we think about this, if we have all-time low in young coins, about 15% of the supply is young or younger than 3 months, then that means we have an all-time high in older coin supply. So all the coins that are older than 3 months represent 85% of the supply. So again, what this is looking like to me is that we've got some strategic profit taking, but we're not seeing long-term holders go, you know what, this looks like an expensive part of the market. It's time to be exiting all positions. We're actually not seeing that. We're actually seeing that the hodling conviction remains quite strong, and there's some strategic profits being taken, but the market seems to be absorbing it without any issue. So that's how this really looks in terms of the overall assessment of the supply side. So now what we're going to do is look to the demand dynamics. So that's one side of the equation. We're looking at the spending behavior. The reason we look long-term holders is because they're holding some 85% of the total coin supply. So generally what we're looking at is that's where most of the sell side come from. And what we can kind of see is that investor conviction actually remains quite strong. So now when we look at the demand side, let's take that estimate that there's a little bit of spending, but not a great deal. What else can we tell about the market from demand? So I'm going to look at two different sectors here. I'm going to start with the exchange side because that's generally quite intuitive. Exchange balances is a representation when you've got more coins flowing into exchanges. It's generally telling you a story that there's too much supply coming in and the market can't handle it. That's very much what we saw back here in the May period of time. So this is looking at the net transfer volume to and from exchanges. I've got a 7-day moving average here just to smooth out and really look for trends. So when we see big inflows, that's these green bars. So you're seeing coins flowing into the exchange, right? Overall, there's less coins flowing out, more flowing in. That generally suggests there's going to be more of a sell side pressure. Now, what we've seen lately, particularly since September, some very, very large and extended periods, right? Multiple months of lengthy withdrawals. A couple of inflows during the September period, but then look, we're actually seeing acceleration. We're seeing increasing outflows as the market pushes up towards all-time highs. So again, this is telling us a story about the demand side. Even though we're at all-time highs, overall, the spending is being more than absorbed because there's coins flowing out on net. This is down about 5,000 coins per day flowing out of exchanges. And this has actually driven our percent, so the total supply, the percent balance on exchanges down to about 12.9%. Right, we're getting under 13% now. So we're hitting multi-year lows in terms of the amount of coins that are held on exchange reserves. And it's painting this very, very strong picture in terms of the demand, especially in the context of long-term holders that aren't really liquidating a great portion of their coins. So at some point, that supply and demand is going to meet in the middle at price. So the other thing we can look at, and this is what I actually find probably the most fascinating about the current market cycle, is the on-chain transaction activity. So we mentioned before that there was a couple of things about the supply dynamics that looked a little bit like a bear market. And whilst that may sound a little bit scary, remember that a bear market comes before a bull market. We generally see in a bear that the smart money, people who have the long-term vision, people who are willing to deploy capital into a downtrending market and actually accumulate what they believe are cheap coins, they essentially set the floor for where that bear market will end and ultimately create the launch pad for where a bull market can extend from. So whilst bear markets can take time, generally the characteristic a bull market comes in two phases. There's the very quiet early period where it's kind of all the insiders, people who've been around, the smart money, people who've seen this market cycle before. Very, very quiet on-chain activity, much the same as what we have at the moment. Active addresses, number of transactions, and then entity adjusted equivalents. Note how low we are, right? We're down here back in the 2020 period. After March 2020, we had a very, very similar number of active addresses. Our transactions are actually lower than what we were back in 2020. Entity adjusted transactions, look how low we are relative to our previous bear cycle. Many of our activity metrics are showing a very, very quiet transaction space. It's recovering, it's in an uptrend, but it's much, much quieter than what we've seen in previous bull cycles. You can actually see in the on-chain data, note how the bull market picks up. There's more and more new entities, there's more new transactions, there's more people using the network. This is what the hype phase looks like when the media machine is turned on, Bitcoin is on every single news story, and people are flooding in all over the place. So what we're seeing at the moment is exchange outflows of a fairly sizable portion, price up at all-time highs or just below it, a gradually, very, very slightly increasing activity space, which again is not showing this mass hype. It's really showing that the herd, the overall investing populace actually hasn't shown up yet, which is quite remarkable. And what that's telling a story about is you have smart money who are basically not liquidating their coins at this point in time. We have the majority of the mempool is relatively quiet, likely again driven by those smarter money and just early people filtering in, starting to get, early headlines starting to show up. But overall, our current demand dynamics on chain is showing that we're in that quiet first phase of the bull. The second phase of the bull is generally where things really start to accelerate. We see transactions flow in, we see fees really start to pick up. There's a whole lot more momentum, and again, a lot of that's coupled with coverage in media and all the like. So we can see all these investor cycles show up in the on-chain data. And what we're seeing at the moment is that by and large, our new entities coming in on-chain looks like 2020, 2019. Number of active addresses, it's increasing, but it looks like 2020, 2019. Very much the quiet before the storm, which I find to be quite a fascinating divergence where we actually have semi-bear market on-chain activity, but at the same time, the supply dynamics still look remarkably strong and prices obviously remarkably strong. So it's a very, very interesting dynamic, and it's certainly painting a constructive picture moving forward. So the last thing I want to touch on is, it's actually one of my personal favorite topics, is the mining market. So what we saw in the May through to June period was probably one of the, if not the largest event in the Bitcoin mining industry's history. We saw over 52% of the hash rate more or less get chopped off within half a month. So miners in China were forced to turn off their mining rigs. Many of them had to move their, liquidate, sell, move their hardware, move to different jurisdictions, or just exit the industry altogether and actually rehome their hardware. So what we've seen is 52% of the mining market was essentially switched off over the course of about 2 weeks. And, obviously this was coupled with a sell-off and, bearish price action, and things looked pretty grim. But what we've seen since that point in July when we bottomed out is we've seen 95% recovery of our hash rate. This is on a 7-day moving average. I use a 7-day or a 14-day usually, just to smooth out the daily noise, gives you a bit of a better read. But note that we are almost approaching the previous highs, right? We have this particular peak up here in May. But what we're getting up into this zone where it's kind of getting to the top end of where the hash rate used to be. So it's showing this remarkable resilience of the Bitcoin network or the mining market to actually the incentives create the drive to self-repair and self-recover. And during this entire time, blocks continued to be mined, the network continued to be operational, transactions continued to be settled, and the difficulty adjustment wound down and has now been in this steady process of winding back up as more hash power comes online. So really what this is just showing is the resilience of the network. We've essentially seen this quiet recovery all the way back just about to the highs. So, it's very possible that if this trend were to continue, we would actually see new highs in hash rate before year's end. So we'll have to see how this plays out because there's chip shortages and all sorts of other logistical dynamics. But certainly quite an impressive example of Bitcoin essentially healing itself through its natural incentive system. Now, speaking of incentives, there's a lot of talk that goes on about the security budget for Bitcoin long term, and there's no question this is one of these unanswered questions, and it's going to be something that we have to really use the data, watch how things play out over time. Just for a bit of backstory, we can't answer that question here, but what we're going to do is just provide a bit of insight into some of the dynamics. What actually drives miners to actually want to put hash rate on the network? What does the incentive structure look like? So what we have here is our total miner revenue. So this is across the entire network. What is the overall income that's being paid to miners by the Bitcoin network in BTC? So you can actually see the halving events, right? This is the 2020 halving event. So we were trading around 1,800 coins a day on average. You can see it fluctuates on a daily basis between 1,500, 2,000. Depends on transaction fees. Sometimes miners drop on and off the network. So you get this kind of natural variation depending on how many blocks were mined. But by and large, on average, the block subsidy is 1,800 plus whatever the fees are. What we then had was the halving event. And then it dropped down to approximately 900 coins per day in the subsidy plus fees. And then obviously plus natural variation. We can see this period during May where coupled with the hash rate declines, or when the hash rate declines this quickly and the difficulty adjustment need, it takes time. Every 2 weeks it will adjust. It takes time to actually wind down and adjust to the new block times that are coming in. So during that time, we actually saw a slowdown in blocks. So when you've got less blocks being mined per day, that means you're obviously going to have less subsidy. There's less issuance. So the actual issuance rate drops until the difficulty can wind down and adjust the puzzle so that it suits the current hash rate. We've now seen that recovery, right? And then we've returned back to this 900 BTC, right? Plus or minus. So what we're seeing is that over time, Bitcoin's overall issuance rate, or the number of BTC that it issued, is declining time by time, right? It's constantly going down. And you could argue that this will continue into the future, and eventually it will get to all-time lows, right? Every halving, it's going to drop another 50%, and it's going to continue to push towards all-time lows. However, most miners' costs, whether it's electricity, whether it's hardware, paying staff, logistics, all of the above, is generally denominated in fiat currency. So whilst their income comes in BTC, their expenses are generally fiat denominated. So then we can map our total miner revenue in USD. And what we actually see is, here's our halving event back here in May 2020. You can see revenue drop from 18 million. Remember, this is for all miners on a daily basis. So $18 million a day dropped down to become $8.5 million a day. But note how price has pulled the mining revenue, and where we are currently is up here about $61 million a day. We are not too far from the all-time high in terms of miner revenue. So yes, whilst we're seeing this gradual decline in miner revenue in BTC denomination, we're actually up 550% at the moment from after the halving. So even though there's 50% fewer BTC being mined, the overall mining revenue in USD is actually up 550%, which again is kind of showing how those incentives of the Bitcoin mining network really step in and allow miners to expand. And really, this is why we have hash rate pushing up to all-time highs. So to close out our assessment, we're going to look at the aggregate security spend, which we otherwise call the Thermocap. So what the Thermocap does is it's calculated by taking a cumulative sum of every block reward, the subsidy and the fee, valued in USD at the time when the block was mined. So the other way to think about this is, what is the total USD value that Bitcoin has issued to miners as a security budget? So you can almost think about the Thermocap as how much has Bitcoin invested in its own security by releasing block rewards. The market values those block rewards in fiat currency. And when we sum all of that together, it's looking at what is the aggregate spend that Bitcoin has done to secure itself. Now, if we go back to the May 2020 halving, the total Thermocap was about $17 billion. So that's telling us that we have $17 billion invested in itself in terms of security. Now, where we currently sit is $32.8 billion. So this is actually a 93% increase in total security spend. So that's pretty close to 100%, which means that roughly 50% of the security budget was invested up until the halving in May 2020, and it essentially has doubled the amount of security spend over the last 18 months. So almost half of Bitcoin's entire security budget has been invested in the last 18 months, and this is despite the overall coin issuance going down by 50%. So when we actually map all of this together, we've got a hash rate that has declined by 92 exahash, and bear in mind that that decline, 92 exahash, is the entire mining market up to October 2019. So it really shows you just how much the mining, the hash rate, the industry has expanded, when a precipitous drop of 52% is essentially the entire hash rate up to October 2019. So from that point, we've seen the hash rate almost completely recover. So the network has been resilient enough to essentially get that hash rate back almost to the highs over the span of about 4 to 5 months. We've seen, even though our coin issuance and the overall block subsidy paid in BTC has declined by 50%, the overall miner revenue in fiat currency, which is what their costs are denominated in, is up 550%. And the overall security budget, the amount that Bitcoin has invested in its own security, has essentially, it's almost doubled in the last 18 months. 93% of it has been invested, $15.8 billion in the last 18 months. So it really just goes to show how much of an impact the market pricing of Bitcoin has on the security budget. We can actually see that miners can provide increasing amounts of hash power, increasing amounts of security, even as the subsidy continues to decline. So whilst there's many takes on the Bitcoin security model, and this is obviously a very, very high level take on it, these are just some of the interesting dynamics that we can look at and pay attention to really just get a bit of a feel and an understanding for how the incentive system works, how proof of work actually functions, and just the overall resilience, just observing Bitcoin essentially rebuilding itself after a precipitous 52% drop. And essentially continue to operate more or less as normal. So really it just kind of shows the beautiful elegance of the Bitcoin protocol and how the incentives align to really bring miners in, bring investors in, and essentially how the system works as a whole. So thanks for tuning in, everybody. I'm really enjoying making these videos. Hopefully you're finding them useful. Do let me know in the comments what you're finding useful, how you're using these videos and the Week Onchain newsletter to really help in your on-chain analysis. How are you finding it useful in your using Glassnode as a suite? So let me know any of your comments, and I look forward to seeing you in the next week. Cheers.